Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for Thursday the 15th of February, the first show in the Year of the Dragon. I hope you had a great Lunar New Year holiday and I wish you a very happy Year of the Dragon. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Consumer Price Index in the United States increased 0.3% in January. That was slightly higher than expected. Analysts had expected a monthly increase of 0.2% and an annual gain of 2.9%. On a 12-month basis, inflation climbed 3.1%, which was down from 3.4% in December. Interest rate futures, which before Tuesday's report implied the central bank would probably begin cutting rates by its May meeting, now suggest a June start is more likely. Mike Gallagher, head of the US House China Committee, will visit Taipei next week with a group of lawmakers in a show of support for William Lai ahead of his May inauguration as president of Taiwan. Washington has warned China ahead not to engage in aggressive activity towards Taiwan in the run-up to the inauguration, when Mr. Lai will succeed Tsai Ing-wen as president. China, in turn, has repeated its long-standing criticism that the US shouldn't meddle in Taiwan. China said it firmly opposes illegal sanctions in a response to a European Union proposal to impose trade restrictions on 3 Chinese firms accused of supporting Russia's war in Ukraine. We're aware of the irrelevant reports. The Ministry of Foreign Affairs says China firmly opposes illegal sanctions or long-arm jurisdiction against China on the grounds of cooperation between China and Russia. Brussels is considering new restrictions on about 24 firms, including 3 based in China and 1 in India. Unofficial results from the Indonesian presidential election predict a win for Defence Minister Prabowo Subianto. Millions of people across Indonesia's 17,000 islands and 3 time zones have now voted for their future president. Unofficial quick count results are showing Prabowo Subianto in the lead, but if no one secures a simple majority, a runoff vote will be held in June. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Hao Hong, Chief Economist at Grow Investment Group. And discussing the latest developments in the oil markets is Vandana, founder of Vanda Insights. And if you have any questions on the show or any comments, please go to my website and post them there, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street's Wednesday, US stocks rebounded from Tuesday's big sell-off following the CPI reports. The S&P 500 advanced 1% to finish at 5,001 after falling 1.4% in the prior session. The Dow added 152 points, that's 0.4%, closing at 38,424. On Tuesday, the Dow lost 1.4% for its worst day since March 2023. The Nasdaq Composite climbed 1.3% to settle at 15,859. And the small-cap Russell 2000 index, which slid 4% Tuesday in its worst day since June 2022, recovered some of its losses, closing 2.4% higher. Traders bought short-dated US government debt, with the yield on 2-year treasuries falling 9 basis points to 4.57% after they surged by 19 basis points on Tuesday, and the 10-year yield dropped 6 basis points to 4.27%. The US dollar index retreated 0.1% to 104.72 after jumping 0.7% Tuesday in the wake of the hot CPI report. And the yen is in focus, having hit the 150 level again, prompting comments from BOJ officials. It ended the day at 150.5 against the dollar, and the currency has now slumped past the level that spurred previous interventions by the Japanese government. Spot gold ended the day 0.1% lower at $1,991 per ounce. Crude oil futures fell Wednesday, giving up gains from earlier in the session as stockpiles surged in the US while demand fell. The Brent contract for April settled at $81.60 a barrel. That's down 1.4% on the day. And Bitcoin has regained $1 trillion in market cap. And Bitcoin also broke through the $51,000 level. That's the first time it's hit that price since December 2021. On Wednesday, Bitcoin ended the US trading session at $51,625. That's a gain of 4% on the day. And in Hong Kong, the Hang Seng Index reversed early losses of 1.8% to gain 133 points, or 0.9%, to end at 15,879 on the first day of trading since a 2-day break for the Lunar New Year holidays. And that follows a record 29% slide in the last year of the rabbit. The tech index rallied 2.3%. Markets in mainland China are closed for the entire week for the holidays, and traders face news that index provider MSCI is removing 66 companies from its MSCI China index in its latest quarterly review. That's the highest tally in at least 2 years. Futures markets pointing to a gain of about 80 points for the Hang Seng at the open this morning. That's about 0.5%. Index projected to open at around about 15,960. And you can get more details on the latest market movements in my daily newsletter at Peter Lewis, moneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Andrew Freris, the CEO of Econosis Advisory. Morning, Andrew.
Good morning, Peter.
And also with us is Hao Hong, who's Chief Economist at Grow Investment Group. Morning to you, Hao.
Morning, Peter.
As we heard there in the introduction, the CPI, the Consumer Price Index, increased 0.3% in January, slightly higher than expected. On a 12-month basis, inflation climbed 3.1%. That is down from 3.4% in December. A key subset of services prices, though, advanced by the most in nearly 2 years, and shelter costs heated up. Shelter prices were the largest contributor, jumping 0.6% on the month, contributing more than 2/3 of that headline increase. Inflation has been falling for the past year and a half, but the numbers released Tuesday showed inflation to be higher than forecasters expected. And the increase likely delays any Federal Reserve interest rate cuts. Andrew, we don't like talking too much about the Fed, do we? But the market's got really in quite a steam about this. This sort of lower than expected decline in inflation. Have they got it all wrong? I mean, inflation is still going down, isn't it? Albeit just not quite as much as they hoped.
Well, actually, no, Peter. It is not going down. It's going all over the place. I mean, it is just not true that the trend is there. I'll just give you the last 4 figures, okay, October, November, December, to show you that the Fed really has got its job cut out for it. 3.2, 3.1, 3.4, 3.1. Sorry, what's that? In other words, it ain't going down. Going down means that for over a 6-month period, at least it slips by perhaps 10 basis points every time. So if the Fed looks at these numbers, they can't possibly say, well, you know, we are getting there to 2%. No, we're not. Unless the Fed changes its target, then looking at these numbers, the markets have got every right to feel disturbed about it, because these are not the kind of numbers that the Fed is going to use itself and say, yes, it is going down and it's going to stay down. That is the other important part. It's no good. I'm sorry, I'm taking a little bit of time over that. It's like going 10, 9, 8, 7, good, it's going down. But if it's going 10, 9, 8, 8, 8, 9, 8, 7, 9, 8, 8, it's not going down. So the Fed wants to see it going down and staying down. And it's not. God, it's a little bit long-winded. They're not exactly Nobel Prize winning stuff. But that's the answer to that, as far as I'm concerned.
So when you read out those numbers, the way it actually sounds like inflation has stalled out at current levels.
Yeah, effectively, that's what I said. It is not going anywhere, meaning it's not going up, it's not going down, and it's not staying steady. So that's why the poor Fed is also going a little bit, neurotic, and it's climbing up the wall. There isn't a real trend. And remember, I'm not doing Fibonacci curves kind of stuff. I'm simply clenching my teeth, squinting my eye, putting the thing a little bit further away from my eyes, and I said, where is the trend going? It ain't going anywhere.
What are your thoughts? If inflation in the US has stalled out at current levels, then that's not what investors want to see, is it?
Yeah, well, I think the market was over-optimistic in the sense that, was hoping inflation to come down in a straight line, and then, the Fed would start cutting in March. I mean, obviously, it's overhyped. I think, as Andrew said, inflation is going all over the place. But I think the PCE inflation is coming down, which is the key figure that the Fed is watching out for. So I think, the path to rate cut obviously is not going to be as smooth as the market is expecting. I think the overcapacity problem in China is starting to export deflation to the world, and also the cheap Chinese currency as well. So I think in this way, the inflation path, at least for the first half of the year, should be coming down. But then at the same time, it's not coming down as fast as the market is hoping for.
So investors have got to really reassess, haven't they? Because they've spent really the first part of this year just arguing that the Fed was taking too long to start cutting rates. But then when you see data like this, it is a warning, isn't it, that inflation could be sticky. There are risks to the upside as well. And it's certainly not going to go down in a straight line.
Yeah, well, obviously, the slack in the labor market is not emerging, right? So even though the rent cost, as everybody was watching, is coming down because of the base effect, but the labor market is showing strong resilience. So there are layoffs here and there, but overall, job creation and also unemployment number is very low. So I think people just have to be patient. But having said that, though, the Fed is not cutting is an acknowledgement of the strengths in the U.S. economy. So it may not necessarily be the bad news. And that is the reason why the market had one-day correction, which is quite large in terms of size. But then, last night starting to rebound again.
Mm-hmm. Andrew, I mean, Jerome Powell has said he wants to see more evidence that inflation is returning to the Fed's 2% goal, and that he's talking about there the PCE index, which is going to come out later this month. But nevertheless, is he seeing any signs that inflation is getting to its 2% goal that's going to make him start thinking this is the time to start cutting rates?
This is the bad idea of people like Powell saying something firmly and then perhaps living to regret it. I still have noted down in my diary and not going to remove it there. But 6 months ago, he said, I don't believe we're going to see inflation at 2%, even in the year 2025. That was year 23 when he said that. So we have the whole year of 24 and possibly the whole year of 25 before we see inflation down at 5. We see inflation down firmly at 2%. Yeah. Remember, this is the thankless task of me simply repeating what Powell has said, as opposed to me telling you intelligently and frowning that I have done an econometric model of the inflation and I'm forecasting where it's going to go. In other words, I haven't done exactly that, but looking at the components of what drives the inflation and looking at the rest of what is driving the American economy, I just can't see a trend developing that will be firmly nearly 30% or more than the current rate. It's as simple as that. It ain't going away. What can we do about it? Except keeping rates up, of course.
How you mentioned in your last comment about China's deflation. We saw China's consumer prices fall at the fastest rate in 15 years in January. Is that going to be exported overseas?
Well, if you look at the import price in the U.S., right, it's coming down. It's slipping into a deflationary territory. Right? So to me, it's a very strong evidence that China is exporting disinflation, at least, to the world. And also, as you see, the Chinese currency is staying weakish. Right? So what that means is that, people would be able to buy Chinese exports, with, lower cost because of the cheap currency. And that's the reason why, the import price in the U.S. is showing disinflation pressure. And I think, the rest of the world will feel the same.
I mean, if you look at the inflation numbers, a large part of it is coming from food prices, isn't it? And if you take the food prices out and energy prices, then inflation is rising, albeit not by very much. Is that something that's temporary, or should we worry maybe that inflation is getting more entrenched deflation is getting more entrenched in China?
Well, if you look at the upstream PPI, it's been in deflationary territory for well over a year now, almost 2 years now, right? So it's very difficult to imagine that, those those costs, those deflationary costs wouldn't be, the deflationary pressure wouldn't be passed downstream to the consumer sector. And also, you're right to point out that, food price inflation has been low, but that is really the pork price, right? So the pork price is down almost 50% year on year because of the pig flu 2 years ago. The Chinese pig farmers had to, raise a number of piglets to restock, but unfortunately, they restocked too hard, right? So, we're left with a severe overcapacity in the pig farming industry. So as a result, the pork price is down 50% year on year in a very important consumption season during the Chinese New Year. But I think even so, if you look at the other items in the basket, it is still showing at least very strong disinflationary pressure. And, if the Chinese authority continue to ease monetary policy to boost supply capacity, then one shouldn't be too hard to imagine that deflationary pressure will come to the other items as well.
Andrew, we're not going to get any economic data out of China this month. And then we've got on the 4th and 5th of March, the two sessions. What do you think should be the priority for the Chinese government in terms of trying to boost the economy as we now enter the new year?
Well, perhaps grit their teeth and clench their fists and decide to look at the causes rather than at the symptoms. In other words, they will really need to ask themselves, why are the consumers not spending? Why are the domestic investors not investing? Why foreign investors are still looking with suspicion at stocks and shares, and perhaps produce their answers. Their answers are politically derived, and it is far from me to say that's one way only that this should be done or could be done, but simply killing the messenger here being prices, it's literally, evading and avoiding the cause and looking at the effect. So I would like to see, let's say, an existentialist view that will take place in these two parallel meetings. And frankly, I have my grave doubts that this is going to happen. In other words, they may continue with more of the same, which is to say that things are doing not badly. After all, the Chinese economy grew by 5%. It's hardly a crisis. The point is that the components of that are flat, and in particular, the animal spirits in terms of expectations, continue to be disappointing.
The problem is that the Chinese economy is operating well below capacity, isn't it? So although the number itself doesn't look too bad, it could be doing a lot better.
Yes, yes, it could, right? But then the issue of inflation, the issue of China exporting inflation, the role of which the Chinese economy can be impacting the rest of the world, and therefore you have a feedback. I have a colossal doubt about that for a very, very simple reason. First, China doesn't export food, but it exports manufactured products. And manufactured products, as Hal has pointed out, have been declining in their price. I'll give you an exact number, 18 months of continuous deflation. Well, it's not something which is happening now. It has been happening for a long time. And now, of course, it is being, let's say, aggravated by a weaker renminbi. And take a deep breath now. Here is where I don't have an explanation. The bilateral deficit with the United States has shrunk. So it's not true that the Americans are buying more than ever because Chinese goods are cheap. On a relative basis, they're buying less, despite the fact that the Chinese goods, presumably they're cheaper, A, because the renminbi has come down, and because domestic inflation has influenced their prices, particularly PPI. So it's not an easy world. So I'm afraid I will beg to differ that China is exporting inflation. It's exporting deflation. It isn't.
Maybe some of those goods are being rerouted through places like Mexico, where China's building up a lot of investments, and they're sort of being disguised as Mexican exports now.
That's where like a cowardly economist I'll hide behind says, yes, Peter, it is a complicated world. Things happen in unexpected ways.
What would you like to see at the two sessions?
I think it's probably going to be steady as she goes. All right. So you're probably going to see policies re-emphasize again on boosting high-end manufacturing sectors and high-tech sectors, trying to build China into a powerful manufacturing powerhouse, et cetera, et cetera. And, many of us were hoping to see, more policy stimulus on the demand side. But obviously, as you can see, demand in China is still weakish, and people's confidence is steady, but not recovering from a very low level. So I think as a result, it's the consumer price is as weak as it can be. So many of us were hoping to see policy stimulus, say, for example, physical transfer from the state to Chinese household, handing out consumption coupon or even cash, probably a tax cut, even though it's going to be less effective, et cetera, but we're not hearing whispers across the grapevines on those topics. So I think for now it's steady as she goes, trying to build China into a manufacturing powerhouse and develop the high-tech manufacturing sector.
But steady as she goes is not going to be good enough, is it, for many investors? They're hoping for more than that.
Yeah, I think if you look at the overall Chinese market, it's down. Like Hong Kong market is down 4 years in a row. Across the world, you would never see an asset price that is down like 4 years in a row, right? So it's just never happened in history. Right? So it's what we're witnessing in the past 4 years is a really strange anomaly. And also, if you look at the overall Chinese market, even though it's not doing particularly well, but I think some of the sectors are actually, giving people very good return. For example, the high yield, low cost, low volatility sectors, year to date is up 7%, more than 7%. It's actually higher than the S&P 500 giving you, right? So it's not all doom and gloom. There are sectors that is still giving out returns, but I think overall, the entire Chinese market is reflecting a sort of a weakish economy.
But what sectors in particular?
These are high dividend yield, low volatility, and large cap sectors.
So utility stocks and things like that?
No, things with a China in the corporate name, like China Mobile, China Telecom, Sinopec, that kind of stuff.
Right.
So things with China, Sino, very large SOEs, they're giving out 7% year-to-date return.
Okay. Andrew, it's been the year of the rabbit. Was a pretty awful month, wasn't it, as Hal mentioned, for investors here in Hong Kong. 4 years of losses now in a row, but even on the mainland, it hasn't been great. What are your thoughts as we now enter the year of the dragon? The year of the dragon is typically a good year for the markets. So are you sort of looking forward maybe to some catalysts that could potentially make it a better year?
Well, I'm afraid unless there is some quantitative good explanation why cusps and conjunctions of stars somehow influence the market, I will say it's nice to hear this. And it's like having a birthday. I mean, it's a nice thing, but I have no idea why I should be celebrating the day I was born, or I would be celebrating a particular cusp of planets. Sorry, I'm exaggerating now because the Chinese astrology is not necessarily based on Western conceptions. But anyway, so would I believe that because the year of the dragon in the past has been a good year, would be this year? The answer is no. I'm afraid I don't have any real reason to forecast that other than say it happens in the past, so it's going to happen in the future. The two things, however, that stay there is American interest rates are high. Therefore, our monetary policy is not determined by the Hong Kong Monetary Authority, but by Mr. Powell, and he has no intention of cutting interest rates, and that has had a twin effect. It has, of course, a twin effect on the stock market, and it has an even worse effect on property. And property in Hong Kong was hit also, a triple effect was hit by what has been happening in China. So Hong Kong is not surprising that it's doing very much down in the mouth and is very likely to stay so, precisely because of the high interest rates and the poor performance of the property sector. Now, I will have to take the punch bowl away completely now, what a nasty man I am, by pointing out that tourism also, it's not anywhere near recovering what it was before COVID. And of course, this does have an impact on the property sector via the hotels and to some extent via the retail sales and therefore on the retail property sector and so on. And this is doing better, of course. Now we ended the year with about 30 to 31 million visitors compared to what it was happening in 2017, 18, and 19, when this was double. It was 60 to 64 million tourists. And it looks as if there is a movement now of the mainlanders not coming here for a stay, but coming here for a quick spending spree. Therefore, that's good news for retailers, bad news for hotels. And it's reflected exactly to what our Hong Kong Chinese are doing. They spring over to go and have a nice meal in Shenzhen and come back again.
What do you make of the MSCI changes? We're going to have 66 companies removed from the MSCI China index. Its weight in the global index is falling now to about 25%. India's weighting is going up. They're adding companies to the index. What's the significance of this?
Yeah, I think MSCI came out and said that China's sector weight in the overall index hasn't changed, right? So that's good news for China. But then having said that, one shouldn't be too surprised to see, because of the investability of the Chinese market and also many of the Chinese companies, especially the developers, has plunged in price and market cap. And therefore, they should be either, removed from the index because of the uninvestability, or reducing weight because of the market cap size. So we were not surprised at all, and I think that is the reason why yesterday MSCI made the announcement. I think the Hong Kong market made the comeback yesterday, despite a very heavy loss at the opening following the US down day. So I think all in all, the adjustment to MSCI index is anticipated, because, these things are scheduled beforehand. And also, over the past 3 years, past couple of years, one of the major stories that's been going on, for, the Chinese stocks is that, China is going to increase in weight in the MSCI emerging market index. So that people have to, rebalance their portfolio, and therefore, they should buy the Chinese market. But I think now, because of the US-China relationship has changed, there could be possibility that MSCI may not even include, many of the Chinese stocks into the index, because of the investability issue, and therefore, portfolio managers are not in a hurry to add back, many of the Chinese stocks to their portfolio. So if you look at the Merrill Lynch survey, it's showing that long the US mega cap, mega 7, and short China is still the most crowded trade, and actually gaining in favor. So it's weird, because the Chinese market is like at its lowest valuation in history, one of the lowest. So, at this kind of valuation level, you're seeing, excessive pessimism across the board. That's kind of odd at this stage.
When you see those kind of extremes in sentiment and trades getting particularly crowded like that, it often turns out to be a good time to take the opposite side of that trade. Would you be tempted to do so?
Yes, I am tempted. I'm just waiting for a better timing. All right. So because, the sentiment has gone to extreme, and also many of the things in the policy toolbox hasn't been deployed. It's probably waiting for, approval from the top. And also, before the Chinese New Year, you've seen, many of the changes that is already happening. For example, replacing the CSRC head. And also the national team has been in the market trying to stabilize, spending large sum of money trying to stabilize the market, et cetera, et cetera. So you can see that, it's sort of, there are many instruments, policy instruments that can be deployed, but not yet deployed. And valuation is extremely low, and also sentiment towards the market is extremely pessimistic. Therefore, as a contrarian investors, you should be watching out for opportunities that is coming probably anytime soon. But then at the same time, because of the market momentum is so negative, and you want to protect your investors' capital, and that is the reason why you're sort of trying to do it, when the market trend starting to show signs of improvement instead of, buying all the way down, trying to catch a falling knife. So, there are many considerations. But I think China in the year of the dragon, after falling, 4 years in a row. So it could fall for another year, but, probability speaking, and also, judging from the history, the likelihood is actually quite small.
Mm. Andrew, would you be tempted to take the other side of that crowded trade and start selling some of these US mega cap tech stocks and instead buy some good quality Chinese companies?
I'm afraid I will do neither of those things, because my naive but consistent view is I will not tell my clients to start buying equities in the United States until and when the Fed cuts, and to follow it. I know they would have lost the big jump, but that's the way it is. And in the case of China, I will buy Chinese stocks at the back of some very significant policy changes. Mm. If I'm going to wait for the macroeconomics to play along, it's going to be 6 to a 9 month period. So, I don't have an event in China except, perhaps we're going to have the twin meetings in March, and some policy decisions may come out, but I'm not holding my breath over that. So for the time being, I'm staying negative to very cautious on equities, with the exception of Japan. I like Japan because it's completely off the wall and completely against everything else which is going in the world. Mm. Everybody wants less inflation, the Japanese want more. Everybody have kept high interest rates, the Japanese have kept 0 to negative interest rates, and they're still not increasing.
And it looks like it's going to get back to an all-time high, doesn't it? It's only maybe another 1,000 points or so to go on the Nikkei, and it gets back to its December 1989 high. Tell me what you think about these support measures that the Chinese government is coming out with, all sorts of talk about stabilization funds, changing the head of the regulator, the CSRC. Are you convinced by those measures? Are they going to work?
I think for now it's stabilizing the market, because, there are, structured products in the marketplace that is dragging the market down, right? So, the funds, the national teams, rescue and also replacing of the CSRC head, are all significant moves to trying to stabilize the market. Having said that, though, I think, people were, really looking for stimulus or some sort of supporting measure to the market and also to the economy. But I think one thing that people fail to talk about is the structural change in the Chinese economy, right? So from the industrial structure to the export structure, it has changed dramatically. And this is the thing that people hasn't been talked about enough, right? So for example, do people know that the value-added industry is now contributing more to the GDP growth than the property sector? Right? So that is probably many people didn't know, a fact that many people didn't know. And also the export structure, the US economy has become less important to Chinese exports in the sense that, US used to be the top export destination for Chinese exports, but now it's looked to second or third. Southeast Asia, the Asian nations has been, the top export destination for Chinese exports. So as you can see, the Chinese exports, the trade surplus with the US or the US versus China, the trade deficit is coming down. But then Chinese exports surplus to the Asian nation is going up. It's actually going through the roof. And also the trades with Russia and also Middle Eastern countries as well. So this is a dramatic shift, and it's beginning to be reflected in the global, in the Chinese reserve management. For example, cross-border payment in terms of currency, the Chinese RMB has been the top currency for settlement for cross-border trades. And many people didn't know that. So there are significant structural change. I think when people look at the Chinese economy, there's so much misunderstanding in the sense that, it's still trying to follow the old playbook, to to see, what can be done or what policy should come out to support the economy and the market. But, just now, as I mentioned, that, even for the market, the pockets of opportunities in place that is giving out good returns. And for the entire Chinese economy, if we continue to stimulate the Chinese property sector and, foregoing the rising opportunities in the high-end manufacturing and high-tech sectors and also the consumer sectors, we're probably going to, push the Chinese economy over the cliff. So I think right now, a structural change takes time. It'll probably take 5 to 10 years. And over these 5 to 10 years, you're probably going to see, difficult sort of restructuring, massive layoff, et cetera, et cetera. Similar things happened in 1998, between 1998 to 2003. And there was a tremendous sort of restructuring going on in the Chinese economy, right? So we restructured the SOEs, reshuffled the shareholder structure, changed the interest rate policy, and also restructured the forex exchange rate formulation formulas, et cetera, et cetera. So, those are the 5 years that is, that the Chinese economy saw huge, significant change in those 5 years. And then after that, it was a very long and prosperous period for the Chinese economy as well. I think right now, people just have to, look at both, what is going on in terms of opportunities and also, some of the risks that is rising from this restructuring, and also the geopolitical risks such as the Sino-US relationship is also sort of working in the background, holding back some of the changes that is happening.
Andrew has said the point there on the restructuring. It's putting China in direct competition, really, isn't it, with the US and in the EU as it moves up the value chain. It's now competing with the high tech sectors that traditionally Europe and the US have been good at.
For those of us old enough to remember Japan, my God, this is absolutely boring, Peter. It's exactly what has happened with Japan back in the late 60s, 70s, and 80s, when competition with the United States became so bitter that there were political issues about rediscovering Pearl Harbor and using the atom bomb again on Japan. So yes, that's the way it is going. Is China's specific aim to compete? No, it's China's specific aim to become a big industrial economy. And why they are obsessed with industrial economics is because value added is much higher. The standard of living depends much more on manufactured goods as opposed to fresh pork and vegetables, and hence the nice, let's say, Arcadian kind of an economy where everybody lives happily ever after in beautiful countryside and they raise their own food is really not only a thing of the past, but it is non-feasible, because then you will never be a powerful economy. So that was a long-winded answer to saying, yes, they are, and yes, they not necessarily think that we're doing this in order to beat those Europeans or to beat those Americans, but it is because that's the way the rest of the world is going, and we're going that way as well. Electric motor cars is a classical case, okay?
Well, we'd love to continue the discussion longer. Fascinating comments there, but sadly we've run out of time. Thank you both very much. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, and Hao Hong, who is Chief Economist at Grow Investment Group.
Peter Lewis's Money Talk.
I'm joined now by Vandana Hari, who is founder of Vanda Insights. Morning, Vandana.
Good morning, Peter.
Rather volatile time for the oil markets at the moment, isn't it? We saw them show some strong gains earlier in the week, gave them all up overnight. It still seems the Middle East is the main driver at the moment.
Oh, it very much is. So crude remains quite buoyant, and we've seen this since the start of last week because of ongoing concerns over the Gaza war. Earlier, we had seen crude retreat as the prospect of a ceasefire came into view, but those possibilities have now retreated, and so crude has stacked on some risk premium. Again, to be very clear, supply volumes from the Middle East have not been impacted by what's going on in Gaza or by the Houthi attacks in the Red Sea. They have forced tankers to take a longer route via the Cape of Good Hope, but the actual supplies from the Middle East have remained stable. So it's a bit of a tricky situation for the oil market, as in, what sort of risk to factor in is very hard to say. But nonetheless, I would say there's easily about $5 to $6 of risk premium in crude prices right now.
Okay, but of course the other aspect to all of this is the demand side of the equation as well. We seem to be getting some rather wildly differing estimates from what global demand is going to look like, depending upon whether you ask OPEC or the EIA. Not very consistent numbers at the moment. Yes,
that has become quite a problematic situation for the oil market. Whether you look at short-term, medium-term, long-term, over the past few months, the sort of rival narratives put out by the International Energy Agency and OPEC have become quite a point of discussion in the oil markets, with the IEA increasingly taking quite a bearish view on global oil demand, and the OPEC maintaining that oil demand growth remains quite robust. The main difference between the two arises from the IEA taking a far more optimistic view of how traditional fossil fuel consumption is being replaced and will be replaced by alternative energies. And on the ground, especially in Asia, and I was at a major energy conference in India last week, India Energy Week. On the ground, you hear a much more pragmatic view from policymakers and energy market stakeholders that a lot of the replacement is that perhaps the IEA is taking into account in terms of fossil fuels is wishful thinking. The emphasis here in developing countries remains on energy accessibility, affordability. So I would think that perhaps, the IEA is downplaying the role of fossil fuels in the coming years and decades. We'll see how it shakes out. But for the time being, it is a major challenge for the oil market, because all said and done, you want to have some sort of reliable, tangible expectations of the next 5, 10, 15 years. And especially when you're investing billions of dollars in major upstream projects or downstream projects like refineries, and the market is left scratching its head, especially between these two starkly different scenarios being painted by the two.
And if OPEC has a rather bullish outlook for global demand, it sort of begs the question, why are they cutting output? Is there any sign that those cuts that were made last year are going to be reversed?
Yeah, so that is also adding to the confusion. It's quite counterintuitive. You see OPEC's monthly report, and its latest report came out just earlier this week, maintains continuing strong demand growth this year, close to 2 million barrels per day. And yet OPEC last December decided to cut output, at least for the first quarter of this year. And the expectations are that they will maintain this additional cut. They'll roll this over into the second quarter as well. So I would imagine OPEC is itself struggling to get a handle, at least that analysts are struggling to get a handle over how global oil demand growth will pan out this year. I think a lot of it depends on how the global economy shapes up, what happens, especially in the US, also with regard to the Fed's rate cuts. We know that there has been a lot of mood swings in the markets based on expectations of how much, how soon the Fed will cut rates. So on the demand side, it's somewhere between perhaps a little bit bearish compared like with last year to, same as last year, which would be the case in a good, strong economic growth scenario.
And where does the US fit into this? Is the US is its production still at record highs or close to record highs?
So if you look at US production and US consumption, which is equally important, being the biggest consumer, again, a picture of contrast there. So yes, US production was on a very strong growth path in 2023. It surprised to the upside with a 1.1 million barrel per day year-on-year growth to new record highs, close to 13 million barrels per day. The growth rate is expected to come down substantially this year. But nonetheless, the US is now, by a big margin, the biggest producer in the world. Growth in other countries that are outside OPEC plus, Guyana, Brazil, Canada, is also quite strong. So there's plenty of supply coming into the markets. If you look at US oil demand, however, it remains well below 2019 levels. So what is clear is that the US is not going to recover its pre-COVID demand ever. The US and for that matter, OECD Europe are both well past their historic oil demand peaks, which means it's only going to be a downtrend from here. And all the demand growth is going to come from Asia. Now, of course, China, though at a much slower rate than what we've seen over the past 2 decades, and India. India is expected to contribute much stronger demand growth than China in the coming years.
Now, India is becoming quite significant, isn't it, in terms of the global market for energy? And also it's going to join the International Energy Agency, I believe, which is also a significant move, isn't it?
Yes, it's a little bit curious to my mind, because the IEA is actually an organization of the developed countries, and India, as we know, is still an emerging economy. I would have thought that perhaps it would join as an observer because, clearly the likes of IEA, OPEC are becoming more interested in keeping their ears closer to the ground in India in terms of getting a better handle of what's the oil demand, oil production, and getting good data from the country. So we'll see. I think it'll take some time for the IEA to make a decision and formally include India. But I think, more than anything, it is a signal of the emergence of the importance of India on the global stage in terms of just the world needing to understand more what's happening in the country and what to expect of the country's energy demand growth. Not just demand growth, but how it will pan out between the traditional fossil fuels and newer forms of energy and cleaner forms of energy like renewables and biofuels.
I mean, India is going to be have some significant energy needs, aren't it? We saw in the budget a couple of weeks ago they're spending record amounts on infrastructure, building new roads and railways and ports and so on. And also they want to move up the value chain, develop electric vehicles as a major industry. This is all going to require significant energy needs.
Absolutely. So India is reaping the demographic dividend, possibly at least until the end of this decade and possibly into next decade as well, before the demographic dividend starts to wane as well. Because again, let's keep in mind that India's population growth has already fallen below the replacement rate of 2.1. So, it would be wrong to draw a, straight upward curve from here. But nonetheless, this is India's decade, no doubt. And exactly as you mentioned, the post-COVID economic rebound has been accelerated and amplified by major, unprecedented investment in infrastructure by the Modi government, which they promised to continue with that sort of investment into the coming financial year as well. So, when you're building infrastructure, that in itself requires more energy, more oil. But also once you build the infrastructure, you have better highways, bigger airports, you find people traveling more as well. Which is again something I've seen firsthand on the ground in India, which is happening as well, which also then means more oil consumption. So at this moment, India has a very strong momentum for energy consumption growth as well as oil consumption growth. But I would expect that to sort of start moderating, but perhaps not until next decade.
India's become the master, hasn't it, at sourcing oil at very low prices on the international markets, whether it comes from Russia or Venezuela or elsewhere. They have really taken advantage of some of the problems in the world, really.
Yeah, that's an interesting topic, Peter, because you look at India, you say, okay, its energy demand growth is phenomenal. It's also becoming more dependent on imports, because its domestic production of crude and natural gas is very, very modest. India last year imported 90% of the crude it needed. It imports about 45% of the natural gas that it consumes. And then you think, and look at what's happening geopolitically in the world outside, and this clearly doesn't bode well for the country. But perhaps counterintuitively, but I would say happily, India is really coming into its own on the international stage. It's learning we've seen that at COP28 as well. But we've seen India make the most of these massive geopolitical shifts and trade shifts that we've seen post-Ukraine war. India imported close to 40% of its crude from Russia, which means 40% of its crude came at a very substantial discount to what it might have normally bought in the international markets. And again, as U.S. has lifted or suspended oil sanctions against Venezuela, India has turned to buy some Venezuelan crude as well. Nowhere near as much as the Russian crude that it can consume. There's limitations on how much Venezuelan crude India can get. And Venezuela is, of course, a much smaller producer as well. But nonetheless, India is learning how to navigate, to not just survive, but perhaps thrive in this environment of growing geopolitical flux.
And what is India doing in terms of renewables?
So it's quite ambitious targets especially on solar power. Solar power costs have gone down tremendously, which is, a huge advantage to the country. But all said and done, 50% of Indian power comes from coal. So what we need to remember is, despite these ambitious targets on renewable power in India, it will take a long time for the country to wean itself off coal. And I think that's key to remember. So for India, when it comes to energy, it's about security, affordability, and reliability of supply as far as it's dependent on imports for its energy needs. That means the Indian policymakers are going to continue taking an all-of-the-above approach. They can't afford to say no to anything, whether it's fossil fuels or it is newer forms of energy.
Vandana, always a pleasure talking to you. Thank you very much indeed.
Thank you very much, Peter.
That's Vandana Hari, who is founder of Vanda Insights.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Sam Favre, CEO at Mandarin Capital. With a view from Australia is Toby Lawson, the CEO of Staten Partners. Bye for now.
Money Talk